After the release of November's Nonfarm payrolls data, the US dollar nosedived to around 105.5 points, extending its losing streak to 3 consecutive days. The dollar's drop is puzzling given that the US labor market added 237,000 during the month, so the report was stronger than expected, providing more room for potential interest rate cuts by Fed Reserve. However, the optimistic outlook was tempered by the rising unemployment rate, which accelerated to 4.2% in the United States. Now let's take a look at the economic data set to kick off next week. How will the reports shed yield for December 9th and 10th influence currency markets? You're watching Traders Calendar. Let us start with Asia, specifically Japan, where the third quarter GDP report will be released. Forecasts indicate a sharp decline from a plus 0.9 to minus 0.2%. A drop in external demand and reduced capital spending have weighed heavily on the Japanese economy, leading to this contraction. And such data typically diminishes the yen's attractiveness in the currency markets, potentially pushing the dollar-yen pair higher. Another critical report for the yen will be the GDP deflator, a price index that measures changes in prices of goods and services. Growth in Japan's deflator is expected to slow from a 3.2 to 2.5%, indicating weak inflationary pressures. And this could limit the Bank of Japan's ability to raise interest rates, thus keeping the yen under pressure against the US dollar. Meanwhile, China's inflation is forecast to accelerate to 0.5% amid recession fears and deflationary trends in the country. This report could be a positive signal. Rising prices suggest stabilization, which is favorable for the yen. In addition, this could increase demand for the commodities, including crude oil, driving WTI and Brent prices up. However, the situation is not all rosy. China's producer prices are expected to continue to fall, with a projected annualized decline of 3%. As a weakness in the manufacturing sector continues to hamper economic recovery, this could limit the yuan's bullish run despite rising inflation. Business sentiment in Australia also appears to be waning. The Business Confidence Index for November is projected to come in at 4 points, down from 5 points last month. Notably, October's reading was not only the first positive indicator in the 3 months, but also the highest since January 2023. A confirmed decline in economic activity could weigh on the Australian dollar. And the Reserve Bank of Australia is set to announce its rate decision on this day, ensuring a heightened volatility for the Australian dollar, although the current 4.35% rate is expected to remain unchanged. Remarks from the Reserve Bank of Australia Governor Michelle Bullock during the press conference 1 hour later could act as a significant catalyst for sharp swings in the market. The European Central Bank's December meeting is drawing closer, and there are widespread expectations that the regulator will cut interest rates by 0.25%. However, recent reports increasingly point to rising inflation in the Eurozone. For example, German inflation is forecast to accelerate to 2.2%, while this alone is unlikely to derail the ECB's plans to lower rates. It could contribute to a short-term rally in the euro against the dollar. The United States is set to release a quarterly report on the unit labor costs in the non-farm business sector, and this metric reflects the total cost of hiring workers and serves as an indicator of production costs, stock prices, and inflation trends. A projected decline from 2.4% to 1.9% signals easing labor market pressures and a lower inflation, given the proximity to the Fed Reserve's interest rate decision. This report will be of particular importance. A lower labor cost growth rate could weaken the dollar by reducing the likelihood of a further Fed rate hikes. Please note that the publication times are set in the GMT plus 3. The next video review of a trader's calendar will be released on a Tuesday, December 10. We wish you profitable trading and see you soon.